Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate jargon to reveal the real story. And today we're diving into FMC Corporation's latest report. And let's just say it looks like FMC is getting ready for a serious shakeup, a foundation shakeup. So what is going on here? FMC is telling us they're kicking off something called Project Foundation. And this isn't just a small adjustment, this is a big plan to really streamline how they operate and make things cheaper. Think of it like a company wide, deep, clean, and renovation all at once. The main goal here is to make FMC more competitive, especially against generic products by making their own production cheaper. They're also cutting costs in Asia because they're planning to sell off their commercial operations in India and generally just trying to make their whole company structure leaner and more efficient. This whole overhaul is expected to save them a massive amount of money once it is all done. We're talking about over $175 million in savings every year by the end of 2027. That is a huge number, and it shows how serious they are about cutting costs. Now, to achieve these savings, FMC is going to have to spend some money up front. They anticipate spending between $560 and $635 million in total before taxes. A big chunk of this $420 to $440 million is going to be non-cash charges. What does that mean? It means they are writing off the value of assets like equipment and buildings because they are no longer going to be used or are becoming obsolete. It's like selling a car for way less than you originally paid for it on your accounting books. Digging into the cash part of these restructuring costs, they expect to lay out between $140 and $195 million. This includes things like paying severance to employees who might be leaving, which could be between $50 to $80 million. They're also bringing in consultants and other professional services to help them manage this big change, which they estimate will cost about $10 to $20 million. And finally, to raise another $80 to $95 million for things like shutting down old facilities and breaking contracts. It's important to note that these numbers could change. Companies often update these estimates as they get closer to actually doing the work. They expect most of these restructuring actions to be finished by the end of 2027, so it's a multi-year plan. And they're being upfront saying that future actions or changes in their assumptions could make the actual costs different from what they're projecting now. Now, to raise another interesting point in this report, because FMC's stock price has dropped significantly, they're now required to check if some of their assets, namely goodwill, and other intangible assets have lost value. Goodwill is essentially the premium a company pays for another company above its net asset value, often representing things like brand reputation and customer loyalty. If FMC's stock price does not recover, they expect to record a big non-cash charge for this. The good news is this accounting charge will not affect their actual cash flow from business operations. It's more of an accounting adjustment reflecting market perception than an operational drain. Before we wrap up, the filing includes those standard forward-looking statements. This is basically a legal disclaimer from FMC saying that all the projections and future plans they've talked about are based on their current best guesses, and the actual results could be quite different due to various risks and uncertainties. They're essentially covering themselves by saying these are not guarantees. They also state they do not plan to update these statements unless legally required. So what is my take on all this? FMC is clearly in a period of significant transformation. Project Foundation sounds like a necessary step for them to stay competitive, especially in a market where generic products are always a threat. The planned savings are substantial, and if they can execute this smoothly, it could really improve their profitability in the long run. However, the sheer size of the restructuring cost, both cash and non-cash, is notable. The $560 to $635 million price tag for this overhaul is a substantial investment. The potential impairment charge on goodwill also signals that the market has lost some faith in FMC's future prospects, or at least its current valuation. While it's a non-cash charge, it does indicate a disconnect between the book value of their intangible assets and their current market value. The company's direction is clear to become a more cost-efficient and agile player in the agricultural sciences world. The risks mainly lie in the execution of these complex restructuring plans and the potential for unforeseen external factors to impact their turnaround. The opportunity is a stronger, more resilient FMC that can better compete and deliver value to shareholders. In conclusion, FMC is making bold moves to reshape its future. It's a risky but potentially rewarding strategy. We'll need to keep a close eye on their progress and how these initiatives translate into actual financial results down the line. Alright, that's our deep dive into FMC Corporation's latest report. What are your thoughts on Project Foundation and the potential impact of these changes? Let us know in the comments below. If you found this breakdown helpful, please hit that like button and subscribe to Corporate Decoder for more in-depth financial analysis. And don't forget to join our Discord community linked in the description for even more discussions. Thanks for watching and well, see you in the next one.